You're very welcome to this pre-scene analysis where we'll be looking at the February 2018 management case study that's just recently been released by CIMA. Over the next 3 or so hours, in the next 5 videos, I'll be going through each of the main sections in the pre-scene for February 2018, and I'll be talking through the implications of the information contained there as it relates to the management case study exam. So this case study, it's an interesting one. It deals with an oil company called Nortan, and actually it's a little bit unique because more than that, it's dealing with a particular department within Nortan to which you belong, and it's a shared service center that serves the different subsidiaries and the head office at the Nortan Oil Company. So an interesting case. Let's get started looking first at the introductory section. So you're told that Nortan is a major quoted oil company that operates globally, and that most of its accounting information is now processed at the Finance Operations Shared Service Center to which you belong. And you are a senior financial manager at the head office in this fictional country of Centaria, where the Shared Service Center was established in 2002. The currency then, we're told, is the C dollar. Okay, there are a couple of things to unpack in these first 2 short paragraphs. First of all, Nortan is a major quoted oil company. Now, first thing about oil companies, the majors are absolutely massive. They have revenues from about 400 billion up to about 700 billion, the big 7 as they're known, the biggest 7 oil companies in the world. And Nortan, we're told here, is a major company that operates globally, so it's going to be geographically diversified, and that reduces risk. They're not relying on any one market. Of course, it's going to complicate its operations as well, and we're dealing here with a company that has many subsidiaries, over 200 individual subsidiaries, so the act of consolidating financial statements at the end of each quarter and the end of each year is going to be a complex and time-consuming process. And the fact that this company is quoted means it's publicly listed. That means, of course, that there are more financing options should they wish to expand, should they wish to purchase other companies, etc. So, as well as that, you'll be dealing with reputational benefits that come along with being a quoted company. As a stock exchange listed company, the company will be subject to more rigorous assessment by the market, and it will have to publish its financial statements, and they'll be analysed by investment analysts, and they need to have their house in order. There's a degree of rigour that comes with being a quoted company. So as well as that, of course, you're talking about certain responsibilities and a certain burden that comes with being a publicly listed company. There are compliance issues, of course, the obligation to publish your financial statements, the obligation to have those financial statements audited. There's going to be shareholder pressure. You might have very influential shareholders that have a big stake in the company, and they might agitate to get their people on the board of directors, etc. And they'll want to guide and direct the strategic direction of the company. So there's that pressure coming to bear. There are expectations that come along in terms of the dividend payouts and the share price growth. And of course, there's a degree of public scrutiny. People are more aware of publicly listed companies, and there are expectations as to how they behave. More so than ever nowadays, often companies are expected to be good corporate citizens. They're expected to look beyond just the bottom line. They're expected to contribute and to be good employers and good citizens. So the shared service centre is taking care of the accounting information that's being processed. As I mentioned, this is a complex operation, and we're going to see what the shared service centre is all about in a couple of pages' time. We'll dig into that in more detail. Also, themes of globalization being touched upon here. This is a global operation, and what this means is that with globalization you have an interdependence of countries. There is increased trade between those countries, increased capital flows, and there's a rapid diffusion of technology. As countries catch up with each other, they copy the technology that is prevalent in other markets. So it's one big global market. Now, the rhetoric in recent times has actually been a little bit against globalization, and there's been a little bit of pullback as countries look to enact more protectionist policies. You think of the rise of Donald Trump in the United States, and at least the rhetoric says that it's going to be more about taking care of America's interests first, and that will have a knock-on effect on the way other countries view them, and other countries will tend then to pull back and become more protectionist as a result. It's actually a very dangerous trend. Anyone who is in any way economically educated and will realize that global trade brings with it many benefits and creates a lot of wealth. And when countries enact these protectionist policies, there's more potential for conflict. So you're a senior financial manager at the head office in Centaria, this fictional country, where the C dollar is the currency. Now, because you're going to have so many cross-border transactions for this company, since it's so globally diversified, that introduces a good degree of currency risk. So we need to see how they manage that risk, or if they're managing that risk with hedging strategies and other strategies like that. In the final paragraph of this introductory section, then you're told that your responsibilities lie in the management accounting area. And what that means is that you'll have to liaise with colleagues in many countries, and you'll have to also liaise with colleagues in Centaria, in the home market, at the shared service centre office, and also at the head office locations based in Centaria as well. Now, just a word on the financial managerial role for this level, the management level. What you're going to be doing is monitoring the implementation of strategy at this level. At the operational level, it's more about executing strategy for the people higher up the food chain. At the strategic level, when you get there, it's more about actually formulating the strategy over the long term. And for the financial manager and at the management level, you fall between those two stools. What you're doing is you're monitoring the execution of the strategy. And you're going to have a midterm focus. With the operational level, it's a short-term focus. With the strategic level, it's a long-term focus. And with the management level, it's a midterm focus. So you could be talking about over 1 year, maybe 2-3 years typically. So you're going to be looking at investments over that time frame, selecting which products and what pricing strategies you'll employ for those products. Risk is going to be a key consideration at this level, as well as longer term finance. As I said, you're going to be looking at investments with a 2-3 year time frame. You're going to have to secure the right financing options for investments with that kind of time frame. So you might be looking at longer term debt. You might be looking at getting equity or issuing bonds or something like that. You're going to have more advanced financial reporting considerations to deal with than you dealt with at the operational level. You're going to have to deal with consolidation. We know this is a company that has many subsidiaries. We'll see that particularly when we look at the financial statements later on. Because you are implementing the strategy for the directors, you're going to have to interact with top management more frequently at this level than you would at operational level. And what that means is that you'll be expected to influence top management. What that means is that the leadership skills and people skills are going to be a little bit more important at management level than they are at operational level. And also, you would be expected to consider more fully the wider environment. Who are your stakeholders? You're not looking inward at the company, at your own company. You're expected to consider your customers, the public at large, the impact on the environment, the impact on the wider community of your business strategies. And you're also expected to consider, for example, political forces and dealing with politically influential people and regulators and things like that. On the next page, we have a little bit about the company background. So we're talking about the Nortan Group, and it was established in Europe in the early part of the 20th century. So this is a company clearly that has staying power, and it grew rapidly, we're told, and it became a major force in the exploration and exploitation of oil reserves in the North Sea. So we know that the North Sea lies between Britain, Scandinavia, and so we could be dealing with a Scottish company, or indeed a Scandinavian company. Of course, there are no real clues in this pre-scene as to where exactly Centaria is based, but we think that it could be modelled on a company based in one of those countries. So the Nortan Group expanded into other regions then through a combination of acquisition and organic growth. So organic growth is going to be slower. Acquisition is a more aggressive means of growth. So you could perhaps expect to see something come up on exam day about acquiring a new company to grow more rapidly. And just a word on the oil industry. Obviously, this is an industry with huge firms, some of the largest firms in the world in terms of market capitalization and in terms of their revenues and profits are oil companies. And if you have to classify the oil industry, you would say it's not a perfectly competitive market where there is lots and lots of competition and lots of smaller firms fighting it out. They're more price takers than price makers. And it's not at the same time a monopolistic company. It's more like an oligopoly. And what happens in an oligopoly type situation is that you have maybe 5, 6, 7, 8 big players. And what they do is they watch each other closely. It's quite a stable type of market arrangement, because all of their moves can be replicated very easily by their rivals. There are high barriers to entry as well, so that contributes to the stability of this particular competitive landscape. And rivals, as I said, keep a very close eye on each other. They can copy each other's moves. For that reason, they don't like to upset things too much with drastic price reductions and things like that, because they know that the others are just going to respond in kind. So they like to keep things pretty stable, and they have fairly good profits. They can be happy with their situation. As I said before, there are 7 global super majors, as they're known in the oil industry. And this company, the Nortan Group, seems to be close to the super majors. It's a major oil company. So the Nortan Group is vertically integrated, and a lot of the big oil companies are. So they have their suppliers integrated into their business. They're not reliant really on external companies. They do almost everything themselves. So in that way, their value system, if you think about Michael Porter, the value chain and the value system, the whole thing is under the company's control. And obviously, as I said before, these are huge companies. Scale is so very important to these companies, and they can achieve economies of scale by growing in size, and that allows them to reduce the unit costs of their production. They can spread it out they can spread their costs out over a wider range of businesses and over a higher number of revenue streams. And with that scale, they're able to make the huge investments that are required for oil exploration and oil extraction. So as I said before, there are really high barriers to entry in this company. It's not like you or I can just start an oil company tomorrow. There are significant investments to be made if you want to start an oil company. So that's a deterrent to new entrants to the market. And as I said before, that contributes then to the oligopoly type structure that we see in that marketplace. So the Nortan Group extracts, refines and sells oil, natural gas and petrochemicals. It's operational then in 85 countries, so very geographically diversified, as I said before, produces 2.8 million barrels of oil each day and has 41,000 petrol stations worldwide. Now, those figures sound impressive, but as with any figures, really what you want to do is put them into context. What do those figures mean? How do they relate to other oil companies, for example? If you take a real life company like British Petroleum, for example, which is considered one of the 7 global super majors and is based in Britain, it is operational in 72 countries, for example. It produces 3.3 million barrels of oil per day, and it has 18,000 service stations, and it is indeed a vertically integrated business, just like the Nortan Group. So that's quite close to the Nortan Group figures that we see there. Actually, the Nortan Group seems to be bigger. It's operational in more countries. It has far more petrol stations, actually. The number of barrels of oil it produces each day are actually quite close, 3.3 million for BP versus 2.8 million for the Nortan Group. And as I said, it's vertically integrated. So quite close to the BP Group, a little bit bigger, in fact. Where the comparison with the big companies breaks down a little bit is actually when we look at the revenues. When we look at the financial statements later on, we'll see that the revenues for the Nortan Group are actually quite a bit under the 7 global super majors, so the comparison breaks down a little bit there. Nevertheless, it's useful to compare those the pre-seen figures with a real life company like British Petroleum. So the Nortan Group, their operations include exploring for oil, extracting the oil and refining the oil, manufacturing and selling petrochemicals, and then operating these 41,000 petrol stations that retail fuel, along with other items like sweets and newspapers, etc., directly to the consumer. So as I say, they're in charge of the entire value system. And one thing about the petrol stations here, they're going to be very important as a differentiator, because when you think about oil, it's a commodity. It's this black stuff that you extract from beneath the surface, the Earth's surface, and one oil company is going to have pretty much the same product as another oil company, so it's a commodity. So the way these companies can differentiate themselves is through their petrol stations. They're selling the same thing, but where they look to be unique is in their branding. When you drive past a BP petrol station or a Shell petrol station, that's what differentiates them. So their reach, their distribution reach, is going to be vital. And brand loyalty is not really going to be massive in such an industry. As I say, one petrol station is going to sell pretty much the same oil as another petrol station. So brand loyalty is going to be a little bit problematic in such a scenario. It's not going to be like the technology sector, where you've got a company like Apple that inspires tremendous brand loyalty and is perceived as being very different to other technology companies, and it's seen as offering something of superior quality. Well, that's not going to be the case for the oil companies. Brand loyalty is not really going to be very high there. So as I say, distribution reach is going to be vital. They need to get those petrol stations on the ground to give them access to marketplaces. So the Nortan Group comprises the parent company along with over 200 wholly owned subsidiaries, 100% owned. So consolidation is going to be complex for these companies. Keeping track of their numbers is going to be tricky, and that's where the shared service centre is going to come in. It also gives them lots of assets to sell off if they need to do so. And each subsidiary falls within one of four categories. One of the big four categories: exploration, extraction, refining, and petrol stations. We'll see that in a little bit more detail on the next pages. And there are 4 senior management teams that report directly into the Nortan head office. So it's going to be a complex consolidation operation of the financial results, of the budget figures and the actuals. And with a shared service centre, what it does is it consolidates a lot of that information, and it tries to simplify the consolidation of these figures. So it's going to have a key role to play there. And as I said before, there are going to be huge investments required in this industry. You think about your P2 studies, investment appraisal, so you're going to be using techniques, simpler techniques like the payback period and the accounting rate of return, and more complex techniques like net present value. You think about then as well any government grants being available and any allowances being available for big investments like the ones oil companies would be making. Soft capital rationing, which would deal with internal restrictions on capital investments, versus hard capital rationing, where you have external limitations being placed on the company that mean it cannot invest to the extent that it would like to. And you think then of options to follow on or abandon or wait. So take a look at all of those areas in your P2 objective studies, and they will be important for this particular industry. And reflecting then on the pest analysis, which relates to your E2 studies, think of the political and legal element of this model. Health and safety is going to be an issue for this industry. You think about the risks people take in drilling for oil, the potential dangers to workers. They're going to have to be trained well, and there are going to be lots of checks and balances in place to safeguard workers. Of course, you're going to also be dealing with government bodies looking for permission to drill for oil. That can be time consuming for these companies. It can be costly as well. It also introduces ethical risks as well. You have probably heard of oil companies offering bribes to government officials in certain countries to win contracts to drill for oil. So watch out for that as well. Company law will have to be adhered to in different marketplaces, taxation rules in different jurisdictions, and environmental agencies are going to be important as well. There have been some environmental disasters over the last decade or so with companies drilling for oil and polluting the seas, and companies have had to pay massive fines as a result of that pollution. The economic part of the pest analysis, exchange rates are going to be important. This is a company with lots of cross-border transactions. The business cycle, the economic cycle is going to be influential as well. Oil is such a key part of what moves the global economy. All industries almost are dependent on oil, and the oil price is going to be a key part of the costs for so many companies. You think of the airline industry, and the extent to which the oil price dictates how they do in any given year in terms of their financial results. International trade, of course, is going to be important. We talked about globalization earlier on. Interest rates, if this is a company with a lot of debt, for example, interest rates would be very important as well. And finally then, societal factors and technological factors with society. There are changing attitudes we've seen in the last maybe 10, 20 years towards the environmental credentials of big multinational companies, and the eye is really on oil companies. They're noted for being polluters, and they're expected to adhere to environmental regulations. They're expected to pay massive fines if they transgress and break rules, and they pollute the environment. And technological considerations as well. You think of alternative energy sources and the rise of those sources, solar energy, wind energy, etc., and how there's been a lot of buzz about those energy sources, but they haven't quite got to the point where they're as economically viable as petroleum and gas, but they're there and they're making progress all the time. Okay, so we dealt with the Nortan group. Let's take a look at the shared service centre of which you are a part. Nortan began to outsource record-keeping functions in the mid-1990s, so quite some time ago. And what that involved was batching or grouping all of the documents received and created by their operating units and forwarding them to an independent company. This was an external company that provided data input and data processing services. So I guess the Nortan Group viewed this as a non-core activity. They wanted to get on with the business of extracting oil, refining it and trying to sell it. That was their core activity, and they saw this administrative task as something that was non-essential, so they outsourced it. And this external company used the documents to update Nortan's records. And what they were trying to do here principally was reduce administrative costs and also create some efficiencies by centralizing the record keeping. And so with efficiencies, what you're trying to do is to have a better conversion of inputs into outputs. And we're going to see that term come up a few times in this pre-scene. And the outsourcing also permitted the operating units, as I said before, to concentrate fully on their core business activities. So extracting the oil, refining it, and then selling it in the petrol stations. So the logistics of transferring the vast amount of documents were very complex, and Nortan actually had concerns about relying on an external partner for what they actually saw as quite a critical area. So not exactly a core activity, but nonetheless quite critical. Receivables are important. The payroll function as well is important. And with improvements in information technology, what it meant was that it was actually becoming easier and more cost effective for large multinationals to create their own in-house shared service centres. So that's what they did. In 2002, Nortan created the FOSSC, the Financial Operations Shared Service Centre. So it's in operation for 15 years now, and technology was a driving force. What technology allowed the operating units to do was to scan their documents electronically, and it was easier then to send them through to a central department like the Shared Service Centre for processing. And this reduced transportation costs and simplified the whole process, the fact that they could scan these documents and all the documents then were received in electronic format. So sensitive information, perhaps in the payroll information and the receivables information. So that would have meant that they were more in favour of having it in-house, and maybe they had legal and ethical concerns. If some of this information got out or was leaked, they would be concerned about that. And with IT systems, we're talking about the capture of data, the storage of data, and the analysis of data. And really in the mid-90s, when they started to outsource this function, what they would have been dealing principally with would have been data capture. So it was more of a low-level type activity and some storage as well. But what we'll see in a little while is that the Shared Service Centre is trying to position itself more as a value-adding business partner for the other departments in Nortan. And they're trying to go a step further and analyse the data to help the other units take key to business decisions. So they're trying to add more value, not just be in the business of capturing the data and storing the data, as important as those two functions are. So there's a shift away from paper documents since the shared service centre was first established. Most sales and purchase transactions are now actually invoiced electronically, which reduces the paper burden and reduces the complexity and the how much time it takes to send the documents back to the shared service centre. And copies of the electronic sales and purchase invoices are forwarded to the shared service centre in electronic files. And similarly, the petrol stations are equipped with state-of-the-art electronic point-of-sale systems in place at the tills, and those tills transmit information about the transactions in real time. And what is very, very important to the shared service centre is their enterprise resource planning system, their ERP system. So these would be large software and hardware vendors like SAP and companies like that. They would have rivals like Cisco as well and other companies, so massive technology firms. And we're talking here about big technology investments for the companies looking to have their own shared service centres. So big capital investments necessary there. And they would need to be upgraded quite frequently as well. So the system tracks inventory at each petrol station and then manages credit card billings as well. Now, as well as capturing all the data, storing the data, the shared service centre needs to be flexible and responsive. And it's using software that allows senior managers to submit more complex queries and to produce more tailored reports quickly and at little cost. So this is more of a recent development. So this is where they're going one step further, as I said before. They're analysing the data, making sense of the data. So they're turning this raw data into useful information, and information can be used to take business decisions. So in addition to processing data, the shared service centre collates budgets across all of the operating units, and it consolidates them into a master budget. And it also generates routine reports that highlight any big deviations, so they would compare their actuals against the master budget and see where there are big differences. And also the shared service centre is processing banking activities associated with payables, payroll and revenue. So the shared service centre is dealing with internal stakeholders. Think of Mendelow's matrix from your E2 studies and the influence that different stakeholders have, the level of interest they have and the level of power that they have. Now, you're mostly going to be dealing with internal departments. They are your customers and you need to influence them, and you need to take into account as well how influential they are, and depending on their power and their level of interest, as per Mendelow's matrix, you treat them in different ways. One thing about the budgets is that the different responsibility centres sending through their budgets, you wonder whether they might be building slack into their budgets or attempting even to get more resources. So there's always that danger with budgets coming from very independent departments. They're often fighting it out for the same resources. They might try to justify more resources with exaggerated expenses projected for the coming year, for example, or indeed they might go the other way and build some slack into their budgets too, so that if they expect that they will be doing better than their budgets perhaps indicate, and at the end of the year then they can say that they've overachieved when really they were really meeting a target that they should have been meeting anyway. So keep those two things in mind when you're talking about budgets. And in the final two paragraphs then of this section, We're told that managing the different areas of a multinational organization means that there are very strict processes and timescales involved, and any deviation from the processes can cause widespread disruption. So very, very important. This is a big risk. Think of your P2 studies and what would you do to deal with risk, to mitigate risk. Think of something like the TARA model, where you're looking to transfer risk, accept risk, reduce risk, or avoid risk entirely. You want to be thinking about the probability of potential risks and the impact if the risk actually does come to pass. And depending on how probable a risk is of occurring and the potential impact it has, you treat it in a different way. So this is a big risk that there will be a disruption to the process, and there will be a time delay or something like that, and that could cause widespread disruption. So I wouldn't be surprised to see something come up on exam day where there's a delay, or one of the processes is corrupted. So this is going to be very process heavy, and the shared service centre is going to have to follow a strict timeline to ensure that senior management has the information it needs to make key decisions. And referring also to your E2 studies, project management, you're going to be trying to balance time with cost, with quality. And it's about balancing those three as a challenge. If you want to get things done speedily, it might actually complicate producing quality work. In other words, it might compromise the accuracy of the reports you produce, and that would be no good at all. Now, if you have high quality work and you're doing it speedily, well, can you do that while keeping costs down, or would you need to invest hugely in enterprise resource planning systems, ensuring that you have the cutting edge ERP systems? So it's about balancing those three. There's going to be a potential for tension between those three aims. Keep those three aims to the front of your thoughts when thinking about the shared service centre's tasks. And just reflecting on shared service centres in general, they are generally accountable as cost centres, and we're told that in the last paragraph there. The shared service centre is operating as a cost centre, and the entire cost is charged to the parent company. So technology, the idea is that with advances in technology that it can help keep costs down, that these processes are no longer very manual. We were told already that it's been a very important step, being able to scan invoices and also having real-time information, for example, coming from the petrol stations, and that makes for a smoother process. It makes for less manual input from human operatives, and that means probably less errors as well. And what happens as well is that with the shared service centres, you're dealing with decentralized day-to-day administrative tasks being grouped under one organization in the form of the shared service centre. So they're taking care of non-core activities, often centralising them to let the other departments get on with their core activities. And the idea, of course, is that with a specialist team, you're looking to improve the quality of these services rather than having a few people each dedicated to these services spread out at each of the different departments. You have a more focused team grouped together, a bigger organization. They can learn from one another. They become specialists in this area. And typically with shared service centres at big multinationals, they have studied the impact of these shared service centres, and what happens is they typically reduce costs, administrative costs, by about 50% on average, but they can reduce administrative costs by up to 70%. So that is a strong argument in favour of a shared service centre. And it allows corporate headquarters to get on with the business of strategizing over the long term, and it allows the different divisions to get on with the day-to-day execution of core activities. And Often you're dealing with a service level agreement for these kinds of organizations. Actually, the fact that this shared service organization is in-house, it reduces the need to have a service level agreement. It would be occurring more often where you outsource these functions to a third party. It would be more important to have a service level agreement where the time considerations, for example, delivery times, would be stipulated very precisely. Also, certain quality standards would be stipulated in a service level agreement. But as I said before, because this is an in-house organization, there's less need for a service level agreement. A little bit more then on the shared service centre's role at the Nortan Group. We have a diagram here that shows us how it operates. At the top you have the head office based in Centaria. As I say, they're getting on with the business of strategy. And under the head office you have different business units. There are 4 of them. One dedicated to exploration, one dedicated to extraction, one dedicated to refining, and one dedicated to petrol stations. And then under those 4 business units, you have different operating units. And underneath, in the text underneath, we're told that each subsidiary is a separate operating unit. So we have 200 of those, remember. And the business units are generally classed as investment centres. So that means they're going to have a good degree of autonomy. They're going to have responsibility for capital investments. They're going to have responsibility for the revenues generated by their business units and for the costs. And those business units can be broken down into individual cost and profit centres. So the petrol stations, for example, they include 65 operating units, each with an average of 30 petrol stations under its control. Each petrol station, we're told, for example, is classified as a profit centre. So they're going to have responsibility for the revenues and the costs. The shared service centre, we were told earlier on, is just a cost centre. So that's all they have responsibility for. They're not looking out after their capital investments. They're not looking at revenue generation, just costs, keeping costs down. And this looks like a divisional business structure that we have in operation here, where you have a head office, but then you have devolved a lot of power to the business units and the operating units. And there are pros and cons with this kind of an arrangement. The pros would be that you do have a corporate hierarchy in place, ensuring some global direction for the company. They're trying to guide the strategy of the company at head office. But then you have the business units with a great degree of autonomy, and they're quicker to respond to unique conditions in their marketplaces and in their business units. And this can perhaps lead to an improvement in customer service and an improvement in the quality of the offer. On the con side then of the equation, what this kind of divisional structure often means is a loss of central control. And that can lead to things getting out of hand. Business units can become overly powerful. They can try to build up their own little empires, and then they can come into conflict with other business units, and you can have rivalries forming, and that can be dangerous to the company. And you have different business units pulling in different directions, and that means that they're not serving the higher corporate goal. And that can be very, very dangerous indeed. It could mean there's a lack of goal congruence across the company. Also, you can have duplication of tasks. If you think about a functional business structure where each function houses the staff from its own area altogether. For example, the finance department is all of the finance staff working under the finance organization. Well, with this kind of divisional structure, what happens is that the exploration business unit, for example, has finance colleagues, has marketing colleagues, etc. Then the extraction business unit has finance colleagues, has HR colleagues, has marketing colleagues, etc. And they're replicated in the refining business unit and the petrol station business unit. So there is a duplication of tasks. It's a little bit more wasteful than a functional business structure. The strength of the value system is going to be important to the company. There's no room really for inefficiencies. They have to keep their costs down because the price of oil is going to be quite volatile and unpredictable in any given year. So they're going to maintain good cost discipline if they want to ensure they have regular profits coming in. So they'll have to manage their own value chain. As I said before, they have control over the entire value system, so they do have a good degree of control. If they're executing their daily tasks well, they can keep those costs down across the entire value system. And then on the next page, we have a little bit more, we dig a little bit more down into the different operating units. We have the example there of the petrol stations. We have the business unit for petrol stations on top. Then you have different operating units representing different regions there, Eastern Centaria, Western Centaria, etc. And then you have a number of petrol stations operating under each region there. So Nortan as a whole is interested in continuing growth, and what that means is that the shared service centre needs to grow in line with the parent company, and it's under pressure to do so. It's under pressure because with growth comes an increasing number of transactions and an increasing number of reports and analysis being requested by senior management at the head office. So the shared service centre is quite reliant on headquarters to invest in upgrading their resource planning system and their IT systems to cope with the increasing volume of transactions. As I said, the shared service centre is a cost centre. It can't invest for itself. It's reliant on head office to do so, which makes it very important for the shared service centre to be able to argue its case with senior management. It needs to influence top management. It comes back to what I was saying on the first page of this pre-scene. And in fact, we'll see later on that the head person at the shared service centre actually has a place on the board of directors at Nortan. So that's very important. It means that the shared service centre has a voice and can argue for resources and argue for investments to be made in their IT systems. They're going to be absolutely critical if they are to deliver on their mission, which we will look at shortly. And the shared service centre is also very reliant on the business units for the quality of the data that they get from those business units and those operating units. They need it in the correct format, they need it delivered on time, and they need to pressure those business units and operating units to do so. That'll be no easy task doing that with 200 different subsidiaries. And it also means they'll have to influence those internal business partners as well. Each operating unit, we're told, has its own budgetary control system, and we know that it's the shared service centre's job to aggregate and consolidate the budgetary reports, and really they have to be looking to standardise those budgetary systems if they can. Imagine if each subsidiary of those 200 subsidiaries is dealing with a completely different way of budgeting. It's going to complicate greatly the task that the shared service centre has in consolidating all of those budgets into a master budget. So that's an important consideration too. One more thing I want to comment on before we finish this first video. E2 Oichi, the issue of control. Bureaucratic control deals with formal structures and procedures. You may have come across this in your E2 studies, and it's quite impersonal and rational. It relies on objective measurement, and this kind of rings true at what we're seeing here. This is a massive, complex organization, and it's important that they exercise a degree of bureaucratic control over the processes, and especially the shared service centre. They're in charge of a very time-sensitive process. They need to follow steps, the same steps on a monthly basis. We'll look at that in more detail shortly. And they need to ensure that those steps are adhered to and that they have timely delivery of reports and that their information is reliable as well. So very formal, and they need the right structures in place and the right steps in place. And it reminds me of Oichi and his theory of control, and particularly when he talks about bureaucratic control, it ties in with what we see here in the shared service centre.